Imagine finding a stock sitting right in the hottest sector on planet Earth, AI infrastructure, that just reported 407% year-over-year revenue growth, a company boasting a staggering $36.2 billion contracted lease backlog. At first glance, this looks like the easiest slam dunk growth story of the entire decade, so the stock must be climbing in a perfect, beautiful straight line to the moon, right? Wrong. Dead wrong. Applied Digital Corporation, ticker symbol APLD, is currently one of the most polarizing, most violently traded stocks anywhere on the market today. And in this video, we're breaking down the hidden mechanics behind this explosive AI data center play, uncovering exactly why the obvious conclusion is completely backwards and revealing whether a massive short squeeze could be about to ignite, plus the precise trade setup to play the chaos. If you're into deep dive stock breakdowns like this one, do me a quick favor and smash that like button and hit subscribe so you never miss the next setup. It genuinely helps the channel grow. Now, let's get into it. But to understand why Wall Street is currently tearing itself apart over this single stock, we have to look at the massive contradiction lying right at the very heart of their financials. The fundamental reality of APLD is defined by one enormous operational paradox. On one hand, you have that historic 407% top-line growth, a stunning testament to their successful transition away from legacy cryptocurrency hosting and straight into the high-margin, high-demand world of AI and high-performance computing, or HPC. It's the kind of pivot most companies could only dream about. But now look closely at the other side of the scale. To fund this incredible transformation, they posted a massive $249.2 million full-year GAAP net loss. Think about that for a second. The sheer amount of capital expenditure required to build out these advanced, next-generation data centers is aggressively deteriorating their near-term profitability. They are spending furiously to build the future. That sounds impressive and terrifying until you look at what this paradox actually did to the stock price over one chaotic 72-hour period. Over just 3 trading days at the very end of July, APLD experienced a textbook technical dislocation. It all started on July 27th. The company absolutely crushed earnings, posting fourth-quarter revenue of $258.7 million against a consensus estimate of just $94.8 million. That massive beat instantly triggered a 6% after-hours surge. Investors were celebrating. But then, on July 29th, harsh reality set in. The market aggressively pivoted its focus away from that revenue beat and zeroed in on something far scarier, their $5 billion debt load. Shares went plummeting 12.8%, cratering all the way down to $23.22. And then Morgan Stanley poured salt directly into the wound, initiating coverage with a brutal street-low target of just $36.50. But wait, because the whiplash wasn't over yet. On July 30th, catalyzed by Microsoft's own earnings confirming absolutely massive AI data center demand, APLD suddenly rocketed back up 20.46% to close at $27.97 on enormous volume. Up, down, then violently back up again. Here's where the story starts to get genuinely complicated, because this wild, gut-wrenching price action isn't just random volatility. It's actually a symptom of a deep ideological war being waged between two completely different types of investors. Market participants right now are deeply, bitterly divided between two completely conflicting valuation frameworks. If you happen to be a bull, you look at APLD and you see a commercial real estate landlord. You value them based on their secure 15-year take-or-pay leases signed with investment-grade hyperscalers and industry titans like CoreWeave. Your entire focus is on that multi-decade contracted future value locked in stone. But if you're a bear, you see something entirely different. You see a highly leveraged developer skating on thin ice. You see terrifying concentration risk, where a single HPC customer generates a jaw-dropping 59% of their current revenue. Bears are pricing in severe execution risk, pointing out that their 12.1% unlevered yield on capital expenditures is falling short of the 15% threshold typically needed to actually create real shareholder value. Two investors, same company. Complete opposite conclusions. And when we attach the raw, hard numbers to these two opposing viewpoints, the disparity becomes almost uncomfortable to look at. This entire paradox is perfectly quantified by 3 enormous numbers. The green flag first, the beautiful $36.2 billion contracted backlog. This is real, long-term, tangible lease validation for their core AI infrastructure thesis. It's money essentially promised on the horizon. But now the red flags, and they are incredibly heavy. They currently carry a crippling $5 billion debt burden, which acts like a giant anchor dragging on their present-day valuation. And to make matters even worse, they burned through $1.16 billion in free cash flow just this single quarter to fund their ongoing construction and facility expansion. Read that again. They are bleeding cash at an absolutely astonishing rate to build the very facilities that will eventually generate all that promised revenue. It's a race against the clock. So before you get too bullish or too bearish, there's yet another critical layer to peel back here. Because to figure out who ultimately wins this brutal tug-of-war, we have to look at the ground truth of the operations. Ultimately, three primary operational key performance indicators will dictate the entire fundamental trajectory of this company going forward. First up is base rental revenue, currently sitting at $44.1 million. If we strip away all the one-time tenant fit-out fees, this recurring base rent absolutely must demonstrate consistent sequential quarterly growth as new gigawatts of power come online. Second, facility delivery timelines. They recently delivered Phase 1 at their Polaris Forge 1 site, but flawless execution going forward is absolutely paramount. In this unforgiving environment, any construction delays whatsoever will result in immediate and severe downside punishment. And finally, the cost of capital. With recent debt tranches secured at 6.75% and 7.00%, keeping a very close eye on future interest rates is critical, because it will directly dictate their net operating income margins for years to come. And here's what's fascinating. Wall Street analysts looking at these exact same metrics are somehow arriving at wildly, dramatically different conclusions. Wall Street consensus on this stock is completely fractured, perfectly reflecting the high beta, ultra-volatile nature of APLD. On the deeply bearish extreme, Zacks Investment Research maintains a strong sell rating, punishing the stock hard for its elevated 12.18 times price-to-sales multiple compared to an industry average of just 2.8 times. Morgan Stanley is also cautious, holding an equal weight rating alongside that painful street-low $36.50 target. And yet, here's the twist. The overall street mean target sits all the way up at $73.36, with Needham loudly reiterating a buy rating and an $83 target. Meanwhile, retail sentiment is just wildly ping-ponging back and forth between extreme, euphoric bullishness and severe panic pessimism. Nobody agrees on anything. But here's the thing. When the analysts are this confused, smart traders do something different. They follow the money. And what the insiders are quietly doing right now is raising some very serious eyebrows. Institutional accumulation contrasts incredibly sharply with insider profit-taking here. Let's start with the so-called smart money, because they are astonishingly bullish. Institutional ownership currently sits at a massive 72.48%. Just in the second quarter of 2026, Equitech proprietary markets loaded up on 8.37 million shares, and giants like BlackRock now hold a commanding 4.3% stake. These are the sophisticated players, and they clearly believe deeply in the long-term infrastructure play. But then there's the inside money, and it tells a completely different story. There have been zero insider purchases over the entire last 6 months. Zero. Instead, CEO Wes Cummins recently sold 165,000 shares for roughly $6 million, and CFO Chuck Hastings dumped nearly 46,000 shares of his own. So it begs the obvious question, why on earth are the very architects of the company quietly taking chips off the table while the institutions are backing up the truck? This fundamental friction creates an absolutely perfect storm on the charts. So let's zoom in and look at exactly how the price action is setting up right at this very moment. The short-term technical posture reveals a highly compressed, coiled spring kind of setup, the type traders dream about. Closing at $27.97, the stock is currently trapped directly beneath two key overhead resistance levels, the 20-day simple moving average sitting at $29.43 and the 50-day at $37.83. Now here's the interesting part. The Relative Strength Index, or RSI, recently dipped deep into oversold territory near 26 right before that explosive July 30th rebound, strongly indicating that the sellers might finally be exhausted. However, and this is important, the MACD still remains below its signal line. What that means in plain English is that while the stock bounced hard, we absolutely need sustained heavy volume to confirm a true and lasting trend reversal. And that, my friends, brings us to the single most important metric in this entire analysis, the one factor that could instantly turn a simple technical breakout into an explosive, violent, face-ripping rally. The massive short interest on APLD provides the primary rocket fuel for rapid upside momentum. Right now, an exceptionally, almost absurdly high 27.02% of the entire float is sold short, representing nearly 69.87 million shares betting against this company. And it gets better. The days to cover ratio currently sits at 4.1, which means it would take over 4 full days of average trading volume for all of these short sellers to actually exit their positions. Now think about the implication here, because it's critical. This heavy short positioning practically guarantees forced buying pressure the moment the stock starts moving up. If that positive momentum from the July 30th rebound gets sustained, we are staring directly at the exact perfect ingredients for a massive short squeeze. Could this be the moment the shorts get caught in a trap they can't escape? But here's what most people miss. The short sellers aren't the only ones trapped in this thing. The options market is currently drawing very clear battle lines for the week ahead. Welcome to the July 31st options battlefield. Gamma mechanics essentially map out the path of least resistance for the price here, and it is a truly fascinating setup. Looking closely at the options chain, the target pin, or the max pain level for the week, is sitting exactly at $31. Above the current price, we have aggressive upside magnets, massive call open interest walls, stacked at the $30 and $33 strikes, each one containing well over 11,000 contracts. On the downside, heavy put open interest at the $24 and $25 strikes provides a solid structural floor beneath the stock. And here's the real tell. We observed a high-volume anomaly of 4,800 contracts suddenly slamming into the $28 calls during the July 30th session. Make no mistake, the smart money is quietly positioning for a move higher. Now when you combine the macro environment, the extreme short interest, and this options data all together, you suddenly get one of the most compelling trade setups on the entire market today. Our tactical trade thesis relies on a high beta asymmetrical long setup driven by 3 powerful converging catalysts, all lining up at once. Catalyst number 1, the macro tailwind. Microsoft's massive AI sector bounce provides foundational market strength, reminding absolutely everyone that demand for AI compute is vastly outpacing available supply. Catalyst number 2, squeeze mechanics. A clean break above that 20-day moving average will force those trapped short sellers to cover their enormous 27% short interest all at once, simultaneously. Catalyst number 3, the gamma pull. As price grinds upward, market makers will be absolutely forced to aggressively buy the underlying stock to hedge those massive $28 and $30 call option walls. When you stack these 3 forces on top of each other, they act as the perfect execution trigger for a highly actionable long trade setup, specifically targeting the week of July 31st through August 6th. So the obvious question is, how exactly do we trade this thing? Let's break down the precise execution matrix, step by step. Here is the complete step-by-step execution matrix. The entry zone sits between $27.50 and $28.10. Ideally, you want to buy on a minor pullback or on a clear confirmation holding above that $27.97 close. Sustaining early momentum above $28 is absolutely critical for this whole thesis to work. If we hold that level, we look to target 1 at $29.43 for some initial profit taking as we test the 20-day moving average. Then, target 2 is the $30 to $31 zone. This is your primary objective, aligning perfectly with that 11,000 plus call open interest wall and the weekly max pain level. And finally, target 3 is a runner all the way up to $32.30, which lines up beautifully with key technical resistance from early July. But as any experienced trader knows deep in their bones, you never ever enter a setup like this without knowing exactly where the floor is. So let's talk about protecting your capital. We absolutely must employ strict risk management parameters, defined clearly by the structural floor of the stock. Your strict stop loss is set firmly at $25.50. This is a hard exit, no questions asked, no emotions allowed. A confirmed break below this level definitively invalidates the entire thesis, signaling that the July 30th macro rebound has completely and utterly failed. And if that $25.50 stop gets breached, the stock becomes completely exposed to the structural floor sitting at $24, a baseline heavily fortified by all that put open interest. Trust me, you do not want to be the one holding the bag if it flushes down to 24. And that finally brings us to the ultimate verdict, and the one question every single investor actually cares about. Is APLD truly worth the risk right now? Before I give you my final take, a quick and important financial disclaimer. Everything shared in this video is for educational and informational purposes only. I am not a licensed financial advisor, and none of this should be taken as personalized financial or investment advice. Trading stocks, especially high volatility names like this one, involves substantial risk, and you can absolutely lose money. Always do your own thorough research and consult with a qualified professional before making any investment decisions. With that said, here's the bottom line. The fundamental risks surrounding APLD clearly sideline conservative, long-term buy-and-hold money. The company undeniably controls a massive, multi-decade $36 billion revenue runway, but they are being heavily choked by the extreme capital expenditures required to actually build the whole thing out. This immense financial strain keeps long-term investors nervously on the sidelines, which, ironically, is precisely what drives up the short interest and the wild options volatility in the first place. But for a nimble, disciplined trader, this creates a genuinely perfect storm for tactical alpha. The exact confluence of extreme fundamental polarization, heavy short concentration, aggressive options positioning, and confirmed technical rebound mechanics all combine to yield an exceptionally favorable, asymmetrical risk-to-reward ratio. Put simply, APLD might be a messy, complicated marriage for a long-term investor, but right now, in this exact moment, it could be a brilliant date for a short-term tactical long position. So now I want to hear directly from you. If you had to choose, are you riding with the bulls betting on that $36 billion backlog, or are you siding with the bears worried about that $5 billion debt mountain? Drop your honest take in the comments below. I read every single one and I'd love to know where you stand. If this breakdown brought you real value, please smash that like button and subscribe to the channel so you never miss the next high conviction setup. Thanks so much for watching, trade safe, and